Good morning. Welcome to our portfolio update this morning on the Apostle Dundas Global Equity Fund, Q3 2022. This morning, I'd like to introduce you to Neil Sutherland, partner, and David Kerr, partner from Dundas Global Investors. And I'd like to bring your attention this morning to our disclaimer. The information provided today is confidential in nature and cannot be shared other than with the permission of Apostle Funds Management. The information is general in nature and doesn't take into account personal financial circumstances or investment objectives. We'll be taking questions at the end of the presentation today, and you can forward questions to us using the chat function at the bottom of the screen. So again, thank you, and I'll hand over to Neil and David.
Good morning. Neil is going to start us, but I think we've just lost Neil with technical difficulties. I'm sure he will join us very shortly. Slide 3 contains the agenda for today. So we're going to talk a bit about, remind you, people who know us well, about the philosophy, and also introduce it to those who are learning about it for the first time. We'll also talk a bit about the quarter. It does seem a long time ago. We're now into middle to end of November, but we'll quickly talk about Q3. And then also got a few stocks in focus at the end. We're going to talk about how dividend growth works, and it doesn't work for some stocks that we don't own as well. So that is the agenda for today. So if we move to the next slide. This is just a reminder, we are Dundas Global Investors, but of course, we're very lucky that the acronym for Dundas Global Investors, DGI, is also Dividend Growth Investors. And that is what we're all about, trying to find businesses that can sustainably grow their dividends over the long term. And we do that because we believe that dividend growth is one of the biggest factors behind long-term equity outperformance. And that's what we strive to achieve, and we achieve that with lower volatility. Dundas Global Investors, we are an independent partnership based in Edinburgh, in Scotland, and the beauty is that we co-invest alongside all investors. It is a very simple philosophy based on dividend growth, and our process is very labour intensive. We sift the global investment universe, looking for companies that can deliver sustained dividend growth, and it's a lot of hard work, but we'll talk about the results in the next few slides. So move to the next slide. Okay, we are saying at Dundas that where dividends go, share prices follow. And this chart shows the MSCI price index against the MSCI World Dividend Index over the last 26 years. And what you can see is really interesting is that actually over that period of time, both the price and the dividend line, so the price line is the grey line, the dividend line is the blue line. You can see that over the last 26 years, that actually both the price and dividend have given you the same return, which is just under 5%. And we add in a sort of a dividend yield of around about 2, you get a 7% equity annualized return, which is probably a number that's familiar to many of you. What's really interesting is that you can see that the dividends are giving you that return with lower volatility. If you look at the standard deviation, you can see that the dividend giving you the same 5% return, but actually significantly lower standard deviation. And for those of you with really good eyesight, if you look at the chart, you can see that during the 26 years, you can see that the price line, there's at least 6 bear markets over that 26 years, but for the dividends, there's only been 2 or 3. In fact, great financial crisis and COVID, so really 2. So you can see that plays to this part. So we are trying to align ourselves with the dividend line, which is much lower volatility, and we're striving to outperform that dividend line. So we'll show you later, the fact that we've returned 10% growth in dividends over that period of time with lower volatility. So that's what we're all about. We'll turn to the next slide. So slide 6. So that is this is a slide we've probably seen many times before. It's from the MSCI, and it's basically done a survey done on behalf of the Norwegian Ministry of Finance, and it's breaking down equity returns over 1, 10, and 20 years. And what you can really see, and it's really interesting, because it plays to what's happened this year. You can see it breaks down the returns between dividend growth, dividend yield, and valuation. And what you can see is that over 1 year, valuation is important, and actually is the 51%, so it is the dominant driver of returns over 1 year. But as we look further out over 10 years and 20 years, you can see that valuation's importance lessens, and actually dividend yield and dividend growth become the more dominant drivers of long-term equity returns, with dividend growth being the dominant factor. And if we think about 2022, what's really happened in markets so far this year is that markets have derated significantly. The corporate news flow has actually been relatively resilient so far, but the markets have been driven by a derating caused by rising interest rates in the back of higher inflation. So that can happen over short periods of time, but over the long term, it's all about dividend yield, but most importantly, dividend growth. And that is why we align ourselves to that factor. Neil, I think, has joined us. Neil, do you want to take over at this point?
Yes, sure. I'm not sure I can get my video going, but hopefully you can all hear me. If we just move on from this, have you gone through this one, David?
Yep, I've got slide 7, yep.
Excellent, excellent. Okay, so what we've been running the strategy now for 10 years, and what has our dividend growth rate been? So we have delivered 10%, and that's been a pretty steady 10% as well. And hopefully what David was talking about earlier, the whole premise behind our strategy is to outperform over the long term with lower volatility. And we believe a lot of that lower volatility is really driven by that superior dividend growth rate, so double what we're seeing in the market. So that's what we're aiming for. We'll talk a little bit about what the dividend declarations have been for this year and for this quarter, though that's generally quite a seasonal thing, which I'm sure you're aware of. So there's not been that many in the quarter, but we can go through the growth rates for 2022. Needless to say, they are looking pretty healthy. Okay, Grace, if we can move to the next one. Okay, so what are we looking for at Dundas then? What makes a good dividend growth company? So we call this our flywheel. And really this is split into two. So that top section with the 4 icons in it and circular motion is a key thing that drives the businesses year after year after year. And what we're looking for is that will then drive the return to shareholders at the bottom through dividend growth. So let's just go through that. So what we look at for all the companies that we invest in, we're looking for at least 10 years of financial history. So these businesses have a level of maturity, but hopefully they've still got a large amount of growth within the future. So we want that revenue line to start with is growing year after year. So we need to be selling more products and services. Now, that might sound blindingly obvious, but what we're not invested in is perhaps a company that has a great product and they hope they're going to sell into the future. So that is not for us. So what we're trying to do is to get those companies that have got that solid revenue growth. Then what we'd like to see, the next icon, you see profit growth. So we want them to squeeze that revenue growth a bit harder. So economies of scale, efficiencies in their business to be able to get higher profit growth. And from that profit growth, what we'd like to see is we'll go into governance. And really what we mean by governance is cash flow. So what does the cash flow look like in that business? And how do they pay effectively or support the key stakeholders that they have in their business? So this is a key element of ESG. So it's what they do with their cash. If you imagine for a business to grow sustainably year after year after year, they need to make sure that they keep their shareholders happy. They need to keep their staff happy. They need to keep their suppliers happy. They need to keep their customers happy. So all of those things are vital. They need to keep the environment happy. They need to keep society happy. So all of these things are really important. And if you neglect one of them, you're going to lose that sustainability over time. So as we follow that cycle round, we go into reinvestment. And reinvestment in our mind is really split into three things. So you can either invest through mergers and acquisitions, and that is more opportunistic, so increasing the size typically of your business, maybe up and down the supply chain. The next option would be CapEx, so building more capacity within your business, so perhaps a new factory or new shops or increasing that size, generally slightly lumpier and very big spends. And the final one is research and development, so really building the products and services for the future. Now, to give you numbers around that reinvestment, our reinvestment in CapEx is really around 6% of revenue in the fund, 7% of revenue being reinvested into capital expenditure year after year. If you compare that with the index number is 6, so it's just slightly ahead. But once you look at the R&D, our reinvestment level is around 8% of revenue, whereas the market is around 2. So a significant increase in that research and development. What I will say is we don't necessarily favor either of the three, because there are different reasons for different companies to do each of those at different times, and you'll get differences within different industries as well. So it's important that we can see that reinvestment rate is pretty key. Now, any of you that are studiers of Miller and Modigliani in the 1960s, and they produced a paper and an argument around, are dividends relevant? And really their argument, very American in style, it was very gung-ho, and they believed that every CEO should be able to reinvest 100% of their profits every year back into the business. Now, we'd go a long way with Miller and Modigliani, but we don't think it's 100%, and we don't think it's every year. So what we want them to do is to, back to that governance element, is to return money to shareholders when they don't have a better reinvestment opportunity. So that's what turns into that dividend growth. Pardon me. Now, that dividend growth is critical because that is the measurement of that underlying business growth. Now, we believe there are different ways that you can repay your shareholders as well. So either through dividend growth or buybacks. Now, our experience in the time that we've been running this strategy is that there's a real covenant between the boardroom table and the shareholders in terms of that paying the dividend. You don't want to cut your dividend once you've increased it. So we think dividends has actually got an element of signaling from understanding that business performance at the top to that signaling going forward. So we think that that is pretty unique. And our belief is what David had talked about earlier, is where dividends go, share prices follow. So ultimately, we are deep fundamentalists. And that's really what we're trying to get over here. Okay, Grace, next slide. Sorry, David, do you want to pass through?
Yeah, absolutely. Yeah, that's fine. So let's just quickly talk about the quarter. So it was another difficult quarter for equities. And you can see there the MSCI All Companies World Index was down 6.2% in dollar terms, but a more palatable minus 0.3 in Australian dollars. It was all really about inflation, bond yields, forcing central bankers across the world to raise interest rates. And I've talked about already, this led to this continued derating of equity markets. Now, I think what we're saying is, there's many things to fear. War, inflation, energy crisis, rising interest rates, I guess, are certainly near the top of the list. But the reality is that so far corporate earnings and dividends, which are obviously dear to our hearts, have held up pretty well. And for the index, earnings have risen by 1.5%, dividends by 3.1% for the first 9 months of 2022. So still modest growth. If we turn to the next slide, Grace, please. This is slide 10. So this is looking at the funds, so the POSL Dundas Global Equity Fund, and you can see the fund returned 1.4% for the quarter, so outperformed by 1.7% at gross level. As we are talking a lot about dividend growth investors, we're fixated by company dividend announcements, and so far so good in 2022. The average dividend increase has been 18% in local currency, and I will come back to that in a couple of slides. In terms of looking at attribution very quickly, you can see there that industrials and communication services were positive. Healthcare was negative, and energy, we don't have any exposure to energy. That was costly again, and I will come back to that towards the end of the presentation. And you see there by region, all regions were positive. If we turn to the next slide, slide 11, Grace, you can see this breaks down performance over from the quarter to inception. You can see there's the quarter I've referenced. You can see that despite the good quarter, we're still behind over 1 year. However, the numbers over the longer term, 3, 5, 7 years since inception, are all still ahead, and with this lower volatility that I talked about as well. So if we go to the next slide, let's return to our favorite subject, which is dividend growth. First thing to say is, in the mornings when we come into the work, we're not that interested in share price movements, market moves. We're really interested in what our companies are saying, and in particular, we're really interested in any dividend announcements. And what this chart shows you is that this is all the dividend announcements from our companies so far in 2022. And the news is clearly good. I've talked already, there's an average increase of 18% across the portfolio, and that's against this long-term average of 10% that Neil talked about since inception, and clearly well above any rate of inflation you care to share with us. Now, we should say we don't believe 18% is sustainable. There's a little bit of COVID recovery in there, plus underlying growth, but the reality is we're very pleased with that number. If you look at the chart and you've got very good eyesight, you can see there is 7 dark bars there, and those are the companies that announced dividends during Q3. And on average, those 7 companies increased dividends by 12%. So it's a bit of a slowdown, but still good growth. And you can see the companies there, Nordson being the star of the show with 27, Accenture 15, Littelfuse 13, Microsoft 10, Marshmac 10, down to Diageo with 5. So let's give a little more detail on stock level attribution very quickly. In slide 13, Grace, please. So this is the top and bottom stock performers over the quarter. If you go to the top, you can see that Ross Stores, which is a discount retailer based in the US, top of the list. And their value-focused business model, it remains well placed to benefit customers who both need and want a bargain. PayPal, actually number 2 on the list. It's been on the naughty step, I would say, for a few quarters as it deals with the loss of eBay and also tough comparatives from COVID, when we're all stuck at home buying goods and services online. But despite this tough comps and eBay, PayPal is still expecting 10% revenue growth with an acceleration in future years. They also talked about finding 1.3 billion in cost savings, part of which will be reinvested to drive growth. So it's returned to form in the quarter, but the shares still only trade on 15 times cash earnings. And despite all the doom and gloom out there, there's a couple of companies, Grainger and Keysight. So Grainger is a supplier of MRO, particularly in the US. They reported 20% organic sales growth in the quarter. Keysight is basically manufacturing, selling electronic test solutions. It reported 13% growth in revenue in the quarter. So despite the doom and gloom, our companies on balance are still giving us good corporate news flow. As ever, as a portfolio, there will be negative detractors. You can see the list of names there. Sonova, which is the world's largest heating company, it did a tougher quarter. It's reduced guidance, talking about reduced demand at the high end and also input cost inflation. And Littelfuse, despite increasing the dividend by 13%, had a difficult quarter in terms of share prices, but actually the numbers were pretty good. And then you can see there Intel, Baxter, and Apple as well in the bottom contributors. If we turn to the next slide, you can see this is portfolio activity, and you can see that we're very true there to our long-term buy and hold strategy. You see there's no new investments during the quarter and a couple of sales. And you can see there's the portfolio turnover levels, the average portfolio turnover of 13.2 and the 5-year average of 14%. So we are very much buy and hold. When we buy a company, we want to own it for a long period of time. In terms of sales, you can see there's OpenText, which is an IT business listed in Canada. It's basically a software business specializing in document content management. We've been becoming more concerned about the lack of organic growth in the core business, alongside the fact that it was becoming very acquisition focused and rising leverage was causing difficulties about their ability to actually do further deals. So we sold the shares, and rather fortuitously, we sold them just before they announced a very large acquisition of a UK company called Micro Focus, which so far has been poorly received by shareholders. We also sold Baxter, and they sell medical devices and consumables predominantly to hospitals. But the reality was they had a very large deal of Hillrom last year. So a combination of rising leverage and slowing growth meant that actually dividend growth was going to be much slower than we hoped for years to come. So we sold the shares. And with that, I'll hand you back to Neil.
Excellent. Thank you, David. Right. Okay. So we're going to look at quite a few numbers here now. What is it we're looking at? So this is a DuPont ratio up until the return of equity. And effectively, we use this and multiply that by the retention rate within the portfolio. If you imagine the payout, so how much of that of those earnings are being kept within the business, which gives our implied growth rate. Now, effectively, this is a portfolio management tool for us. So we use this to look at the summation of the portfolio, and this will give us a guide to what we think the dividend growth rate for the portfolio is going to look like over the coming years. Now, this isn't a science. It has proven a pretty reliable number. And as you'll see, as you can see that premium to the index. So let me just go through a few numbers on this and what this is telling us. Now, if you remember the slide that I was showing you with that flywheel and talking about the quality that we're looking for within those businesses, that's the type of firms that we're looking for, is quality growth. So let's have a look at that. So net income as a percentage of sales is effectively your margin. Okay, so you look at that margin, 14.4 versus 10.2 for the index. So our businesses have better margins. Now, that is vital, and especially in an inflationary environment. So what we see is we see that net income is a very steady number, okay? And when you look at that for the index, it's a lot more volatile. So important things is we've seen an extension of that margin over this year, which is interesting because as we've found the inflationary environment, and what we're seeing is that margin is under attack. And what we've managed to see is a lot of our firms have actually managed to increase margin during this period, which is very, very encouraging. The next line, asset turnover. So how efficient are our businesses? Now, these show us the same number as the index, but if you took that to another decimal point, we are and traditionally have been more efficient. Then the final one is leverage. So lower leverage in the business. So increased interest rates will impact us, you would expect, less than what will happen in the market. So what you see is our superior return on equity. Talking about Miller and Modigliani again, and their view around that retention rate and that reinvestment back into the business, you multiply those numbers together, and that will give you 11.6 versus 7.8. So this is key. So let's just tie that back. Let's just remind ourselves of numbers then. So index numbers over the last 10 years for dividends have been around 5%. For us, it's been around 10%. David has just shown you the dividend growth for 22, which is 18%. That's particularly high. Some of that is the response to some of the COVID impacts that we've seen in some of the French companies. But what we're seeing here now for our growth rate is 11.6. So hopefully what you see in there is a consistency around where we're getting our premium and where we expect the portfolio to go. So we are looking at those portfolio growth rates of around hopefully 10, 11, 12%. Okay, Holly, if we just move on one. Okay, so diversification of the portfolio. Now, what I would say is this doesn't change very much. Based on the turnover that David was talking about, this is it will change in very small amounts over a quarter, so you need a keen eye to see if there's any differences. But let me just bring out a few things for you. So let's start on countries at the bottom. So what you'll see is we're a bit behind in the US, so we're slightly underweight the US. For a long period of time, that's been the case. That's probably a smaller underweight than we've had in the past. But in North America, we are a little bit underweight. We then go, you can see a series of other countries, but let me summarize that for you. We are overweight Europe, and we're underweight Asia Pac, and we're also underweight emerging markets. So that's just bringing those together. Now, those of you, I'm sure we've spoken to you all face-to-face before. The important thing for us is not country of domicile, it's more country of where those revenues are coming from. And what we see is a slightly different picture when we look through this. This is not planned. We are absolutely globalists in our approach. And what we find is these are just where the best stocks that we can happen to find, and showing and giving that most sustainable dividend growth is important to us. Let's look bottom right. So you see technology, 30% or 31% of the portfolio, and compared with 21% for the index, that's 10% overweight. Now, that would, and actually let's look at the other end. So you'll see utilities, real estate and energy, we are absent from. Now, looking at those and looking at those bets, again, this is all from the bottom up. But what I don't want you to think is diversification is not important for us. It's vitally important. And how we tend to think about sectors is more the underlying economic drivers that are happening. Now, we believe there are 35 of those out of the stocks in the portfolio. So we believe there's 35 drivers of economic growth. And if so the key ones I would say would be the highest one is chronic care, around 7%. So obviously has demography and those types of things that are in its favor. The next one would be connected devices, around the digitization of the world, which is on 6.6%, and 6.4% is on industrial automation. So those may sit in technology, they may sit in industrials. Obviously, the chronic care is typically in healthcare, but EssilorLuxottica is actually in the consumer staple, consumer discretionary sector. So actually, the underlying drivers are the most important things that we see in the portfolio to make sure that there's enough diversification. So as I said, just to give you a feel for that, out of those 35 drivers, the top 10 make up about 50% of the portfolio. So what that's saying is there's quite a tail of unique individual stocks. Now, if the world was set up the way we'd like it, we would have 65 completely different uncorrelated names, but unfortunately the world doesn't organize itself in the way that we'd like to see it. So we accept the world as it is, but that's just to give you a feel for where that diversification sits. You just move on, Grace. Okay, just sharing a little bit here on not the most exciting slide. There's a lot of text on this, but this is the carbon metrics for the portfolio. Now, these metrics come from MSCI. So I'm not sure if you're aware, but we do all our own research internally within the building. We take in other information from two places, but we don't take in scores or ratings. It's just the underlying research to give us further information from MSCI on ESG and also on carbon specific metrics. So these are the carbon metrics that I'm showing you. So a quick summary now, as you'll probably have guessed, we have a much lower carbon footprint than the index, largely because we are not in any mining companies, we're not in any energy companies, so that you wouldn't be surprised that our emissions are lower. But our carbon intensity, which is that carbon emissions versus with the relationship to sales, so how much when you're using per $1 million of sales, and you can see that being significantly lower as well. The next column then just shows the average carbon intensity, so weighted average of the portfolio rather than just the list of stocks. A couple of other things to add then, and I suppose what is our role that we see in bringing carbon into the portfolio. So what we try to do is we analyze all of this for every stock that we own, and it's part of our considerations when buying or selling stocks. So what our role in particular is to pick the best stocks. We are not picking them particularly, and we'll talk a little bit about a recent shift in renewable energy. but we are not tending to specifically target certain carbon outcomes. But what you see is within the portfolio is important, especially with any kind of carbon tax that's coming out. Our job is also to engage with the companies that we invest in to make sure that there are appropriate targets. So whether that be net zero, any other science-based targets, scope 1, 2, or 3, and how does that work within each of the stocks? And we need to make a consideration in that in terms of portfolio. What I would also say is the 60% of the portfolio is in the top quartile of carbon scores in terms of that transition between getting to those scores. So what our job is to make sure that they keep that up, but also that any other stocks that are maybe lagging in that we keep the pressure up through engagement to make sure that they are doing that. So the portfolio in terms of carbon is in pretty good shape. Okay, can we move? Excellent. Okay, now what we thought we'd do today is just take you through some of the stocks and some of those flywheels. We've got a few stocks that are held in the portfolio that we've avoided in the portfolio. And one of those is we'll look at Exxon, which is a company that we divested from a number of years ago. And effectively, just to show you at the underlying fundamental numbers in this simplified view of what's happening there and why it's not good for dividend growth investment, so why we would not put it in the portfolio. And we'll also show you a stock that we've looked at in our renewables sift, and you can get, we don't invest in any of those companies just now. Sorry, David, I may have stolen your thunder there, but effectively, David will come up with the detailed stuff as to why we don't. Okay, so let's just look at ASML. So shamelessly started with stock in the portfolio. Now, ASML is a Dutch firm, and it produces the machines that print semiconductors, and they print the ones that are at the higher end. So they are extreme ultraviolet machines. So they are in very high demand just now. So, and have been for a long time. So anything with the digitization and connection, they're at the heart of. Now, these machines are not cheap. I don't believe anyone on the call will have one. They cost about $150 million, and they are sold to foundries throughout the world. So TSMC, Intel, Samsung, etc. So let's just go through some of the numbers. So since we'd held it, so 2012 revenue, company was making 4.7 billion euros. By the end of 2021, that has grown to 18.6 billion. I'm only working on numbers that we have the full years for, just so you understand what I'm going through here. And what has that been? That has, in terms of growth rates, is 16% per annum growth every year. So I would wish the whole portfolio looked like ASML, but did completely different things. But that doesn't always work like that. But these are great numbers. Then as we move through, I talked about that profit line. And what we want to see is a stretching of that profit. So that 16% is turned into 20% from the profit line. Then move through into cash flow. This is a great cash business. We follow that through. The icon I've chosen is that's a semiconductor. This one you could get from PowerPoint. And what this tells you for this business over the past 10 years is they have invested 21% of their revenue in R&D and extra capacity. So that is the engine, the reinvestment. So it's important that they are reinvesting to get those very, very high quality machines. Now, what has that produced at the bottom? That's produced 26% dividend growth. Now, in total return terms, that has gone up about 28% per annum every year. Pardon me. So from where we started the year, or where we started this presentation, where dividends go, share prices follow. This has just been a fantastic growing business. Now, we talk about yield. Yield, I think, is often misquoted to different people and what it means, but that, excuse me, that yield at the start when we bought ASML was 1%. The closing yield is 1%. So many people look at yield and expect as a dividend growth manager that you would see that yield go up. And that's not the case. What that means is we've received it both in the share price and in the dividend. So that is really good numbers for us. David, I'll pass over to go through the non-choice ones.
Yeah. Okay. So I'll let you cough away in the background. So yeah, so Costco, another share that we've held for many years, and you can see this again, the 10-year metric. So Costco, I'm sure most of you are aware, is well, it's the world's third largest retailer, selling everyday staples at low prices in very large warehouses across the globe. There's one near us in Edinburgh, and it's obviously trading very strongly at the moment due to the pressures on disposable income. But the reality is it's a story. It's much more than just the short term, as you can see from these numbers. And actually the long term is really attractive as well in terms of really coming out of their dominant US footprint, growing across the globe, going online. And just really interesting, they have an own brand label called Kirkland, and that's now representing $60 billion of sales per annum. And actually, it's one of the largest brands in the world, which frankly, many people have never heard of. And the great thing about Kirkland is it's got higher margins as well. But enough about the business. Let's look at the flywheel. Let's look at the numbers. And what you can really see here is that they've turned revenue growth of 9% per annum into profit growth of 13%. So that operational gearing, good cost control that we like to see from management, and they've grown their cash by 9% per annum. That seat around the boardroom table, what have they done with that cash? You can see that they've grown their dividend by 13% per annum, and the shares have returned 20% per annum. So actually the shares have returned a bit more than the dividend growth and the dividend yield. The shares have actually re-rated over that period of time, so a bit of valuation appreciation. Now this reinvestment, so Neil's talked a lot about the secret sauce of dividend growth investing being the reinvestment, and actually Costco doesn't do M&A, doesn't really do R&D either, frankly. It spends 2% of revenue in CapEx, which doesn't sound like a big number, but actually because of this flywheel, because of this growing sales, the absolute level of CapEx has increased from 1 billion to nearly 4 billion over the 10 years, which is quite staggering. And that shows how management can keep that flywheel of revenue, profit, and ultimately dividend growth growing. We move to the next slide. Novo Nordisk is another company that we own in the portfolio for many years. And Novo Nordisk, I'm sure many of you know, is a global leader in diabetes and obesity. And it's, I could say, sadly benefiting from the growing number of people with diabetes across the world, and only 15%, according to industry data, who are in good control. And it's just moved into weight loss with this new drug Wegovy, which offers sustained weight loss up to 17 to 18% through a single weekly injectable. And again, sadly, more people are becoming clinically obese, and only 2% of these people across the world are treated today. So again, a large potential market as we look forward. So let's look at the flywheel. You can see that you've got 6% revenue growth per annum. Again, good cost control, good operational leverage created 9% growth in profit, 8% growth in cash flow. And that's enabled management to grow the dividend at 12% per annum with a total return of 15. So we can see 12% growth in divvy plus about 1 to 2% yield pretty much gives us our return over that period of time. Now you can see actually Novo Nordisk is a very big reinvestment. I guess our healthcare companies are characterized by high reinvestment. Part of the reason our portfolio reinvests so much more than the average company in the index. And you can see there that 20% of sales per annum is invested in R&D and CapEx. And I found it interesting, I hope you guys do as well, that actually in 2021, that 20% of sales equates to 24 billion Danish kroner. And that's actually the total level of profits that Novo made in 2011. So it just shows you that power of the flywheel. You keep reinvesting, growing the business. So Neil's really stolen all my chat on the next slide, but let's go through it anyway. Clearly, we have no exposure to energy, as you've seen from the attribution and from the the portfolio details that we showed you. And I guess the key here is that we regard the energy sector as a dividend yield play, not dividend growth. And dividend yield stocks, when we talk about them, tend to be characterized by low growth, little reinvestment, and high and often unsustainable payout ratios. So let's look at Exxon, a company, as Neil said, that we divested from many years ago. Obviously, the world's largest oil company. And what you can see from the flywheel is that Exxon's revenue have fallen by 4.4% per annum over the 10 years. Profits down 5.6% per annum over the 10 years. And cash flow has actually fallen by 1% per annum. But despite that, they've grown the dividend by 4.4% per annum. So clearly that is not sustainable. We've seen a big increase in the payout ratio over that period of time. So clearly they hope that profits will increase to enable that to be sustainable. But the reality is Exxon are a price taker. It's all about price. And you can see there that Exxon only expect 1% unit growth till 2040. So all about the price, which remain volatile. There is little reinvestment in terms of R&D. There's a bit of capex, but the reality is that's going into all oil fields and not enough into renewable space. So dividend yield stock, and hopefully this flywheel shows you why we don't believe it's a sustainable dividend growth stock. The last example, so obviously the other side of the trade of oil is renewables. So we thought we would have a look at the renewable space. So we've just recently concluded a sift. I'm sure we've talked to many of you about a sift where we sift the global universe and we hunt as a pack going across various sectors across the whole global universe. And we just spent a few weeks looking at renewables for us to find investment ideas for us. And we're happy to take you through that another time. But in general, we were really surprised by the outcome of the sift in terms of we found a sector that's barely profitable and frankly, very limited opportunities for dividend growth. And this flywheel on Vestas encapsulates a lot of these points. So it's probably the most high profile renewable company. Obviously, it's big in wind. And you can see there that good revenue growth, 8.5% per annum over the last decade. But the reality is they're unable to turn that revenue into profits. It's barely profitable and actually hasn't grown its cash flow over the last decade either. And it's only reinvesting 5.2% into capex and R&D, which is probably a surprise to us. But the reality is that lack of profitability, that lack of cash flow growth has led to 2 dividend cuts over the last 3 years. So not the company that we would invest in. And with that, I'll hand back to David for us to go to Q&A.
Sorry, guys, technology problems. Thanks for that, David and Neil. It's very in-depth as usual. Thanks for sharing some of their stock stories. I don't seem to have any questions through the chat function at this point. If anybody thinks of any questions, please reach out to us at the Apostle Client Service email address and we'll answer your questions as soon as we can. And we'll look forward to seeing you all again in the new year. Have a Merry Christmas and a Happy New Year. And thanks so much for your support during the course of this year.
Thank you all.
Thank you very much.